Hello, can you hear me? How many people we have in here today who speak English as their mother language? All right. So, we start at the higher time frame. Monthly chart didn't change anything. Weekly chart, we have almost same what we see in the daily chart. It's not the best market structure we are in at the moment. You can see this with this blue candles. They are overlapping and kind of pulling back, and it's not very clear from like which higher time frame bias you have in the weekly chart or something. You just have this big CB, sell side imbalance, buy side inefficiency in the weekly chart. We reacted right here, or still reacting at this consequent encroachment level. So for the weekly chart, there's nothing special, I would say, at the moment. I have down here my levels from the monthly chart and the weekly discount wick. And yeah, for now, there's nothing I would say that's the most important drawn liquidity. So both sides have targets, for example, a pullback or a continuation to the downside or to the upside. That's just speculating. So I focus more on the lower time frame, because also in the daily time frame we can see, like, in the last days or in the last 2 weeks, this kind of, I don't know how to call it. It's just up and down and very dirty market structure. Okay, so today, what was important for me today, I drawed in this wick right here, this premium wick. Okay, and yesterday we had, or on Friday we had the closing price here. Okay, and the open price from yesterday was down here. So that's very I would say, how you say, not normal. Okay, that's not normal that you have candles like this with such a big gap, even when it's a weekly open gap. Um, so in this market conditions, you should be careful what you trade, and especially for your risk management, it's important that you have the right risk. Okay, so not much, because it's just preparing and searching for small liquidity targets, and it's not expanding. Okay, later today in the or yeah, from 4 p.m. after the New York kill zone, we had the move down here. We can watch in the lower time frame. We also watched in the live trading room today with a small short I went in. It was just a small part right here, okay? Because we had here also our first presented fair value gap from today. I will show you. And later, after the live trading room, I got also a small long. So I traded the retracement right here, but it was after the live trading room. So only this we did in the live trading room, and the other trades also gave me around 0.2%. So in conclusion, today we had like 0.6% or something. That's really good actually for a day with low probability conditions. You don't have to make 3 or 5% a day, okay? If you want to be consistent, watch out for your consistency and not your win rate or anything else. Otherwise, you will never reach max allocation at any prop firm. Because, of course, you can do much money in short time, in a few weeks, with prop firms or something, yes. But if you want to be a consistent trader, and if you want to have, or let's say, out of 1,000 people, how many people out of 1,000 can actually trade the same strategy with the same results? Mostly very less, right? So mostly there are like, let's say, 100 or let's say 50 people out of 1,000 who are profitable over a few weeks or make good money, okay? But the question is not how much money some people made. The question is how many people can make money with the same strategy. That's the real question. Because if the strategy is not meant for you, then it's just not your strategy. It doesn't mean the strategy is bad or something. It just means it's not for you. And I want to teach you the ICT system, which is mostly for the mass, okay? Because it's on a long-term way, the masses, like many people, can understand this and have the same results with this system than other strategies from other trader, which mostly works only for a few people out of 1,000. So stick to the strategy which suits to you, okay? That's my goal. I don't want some people to be profitable or short-term profitable. I want that many people, the best case would be everyone in tech markets who wants to learn trading, gets to know the system and has similar results, not only 10 people and not only with the bot, okay? Of course, Sonic is great, but the question is, how long is the bot there? You never know. How long Tech Markets is there? You never know. ICT on YouTube, you also don't know how long he's there. So I recommend learn trading by yourself, and so you have a skill which no one can take from you anymore. Doesn't matter what happen in future life. Sometimes my camera is lagging. I hope it works now better than in the live trading room. If my camera is lagging, just write me a short message, okay? So far with the higher time frame, so we traded down here right now below the previous daily low. In the morning or in the Asia session, we rated the previous daily high, and that's so far what I saw in the higher time frame for today. Okay, after this I went down in the intermediate time frame, 4 hours and 1 hour. There's nothing special which I would draw into here. And we just saw that the weekly open gap got balanced on Monday right here. And today, or from the Asia session, we traded lower after it balanced this inefficiency. Okay, this in the end, this is our inverse fair value gap in the 1 hour chart. This one, okay, but because we didn't had any price which traded here, it was likely that the price will go up here and balance this area. Okay, so it offers fair value for price and for a potential continuation. If that gets confirmed, you always only know in the lower time frame and by time. So liquidity is the language, time is the trigger. Okay, and yeah, so far in the intermediate time frame, in the 15-minute time frame, it looked like this today before it went down. So we had this as our Asia move, and we had from the midnight range or from the London open right here, we had a range. Okay, this was our range, and I always draw into the obvious zones from equal highs, okay, the yellow ones, or equal lows, because these are the zones where liquidity rests and where you have a potential draw onto it. Okay, you don't know when you watch, like, okay, you have both sides, like buy side and sell side. You don't know which get rated first always, but in conclusion, you have to search for aligning things. So what happens when the New York kill zone starts, or when the New York open shows you the first presented fair value gap, and which side got rated until this time point. Okay, so I observed all of that. We can watch this, let's say, from now. We go directly to the 1 minute chart. Here we had our New York kill zone start at 1 p.m. and we had first our buy side liquidity rate, okay, over these equal highs, and it created another equal high right here. Okay, it's the top, it's the high of the midnight range right here. That's the high of the midnight range. For those who don't know, what is the midnight range for the English community right now? The midnight range is a specific time zone from 0 o'clock New York local time. Okay, you can set your trading view chart on New York time, and then you can see 0 o'clock. That there the algorithm starts to set price points and to start delivering the new day. Okay, keep it simple. And between 0 o'clock and 0:30 New York local time, you can calculate which time is it then wherever you live. You take the high and the low. Okay, so this candle right here is 0:30. It starts right here. You don't take this low as your low of the midnight range, because it's the 30th minute. Okay, you take it until the 30 minutes. So the low of the midnight range is right here. It was created at 0.24. And this range, what you got here, is not always important, but can get important for a setup in a London session. It's called the midnight range setup, and it's specifically set up for the London session. Okay, so if you have a liquidity rate or engineered liquidity, for example, like here you had it. Okay, sell side liquidity equal lows. Then you wait for the stop hunt, for the manipulation. So you have your midnight range, okay, and you also can divide this range with quadrants, okay, quarters, okay, and the consequent encroachment is also here the strongest price delivery array, the strongest possibility that price will turn around in this area. Okay, it's not a line, it's a zone. So you always have to consider what price is doing in this area and where liquidity stayed open. Okay, so we have engineered liquidity on the downside. It stayed open. It didn't got raided right here. So we have the manipulation over this high, over this high, over this high, and also over this high. You don't know, and you also don't have to know where price is stopping. You just observe. So you observed it. You saw this reaction. You have right here a lower low, and then you wait for the pullback. Okay, and at this time, if I put it back on Berlin time, we had right here our London session open at 8 a.m. German time, and this was in the London session right after the ICT macro time. And that's after, this is practically your entry because you have a confirmation that the order flow is continuing short. Okay, so you have a lower low, which is the market structure shift. You have the reaction in the PD array in the midnight range, and you had this engineered liquidity. So it got raided, pulled back, continued, pulled back again. That was a stop hunt. Okay, yours, or if you get short right here, and if you are, for example, greedy, the mass is greedy and have their stops right here, then this, your stop loss is another one's entry. Okay, so this was the high probability short for the midnight range. Don't get greedy. Don't think you can get like 1,000 points in gold. Okay, just take the low hanging fruits. And the low hanging fruit, after it got minor buy side liquidity over this high, was in this area. Okay, this there rests liquidity also because it's a single low, and the market always go from internal range liquidity to external range liquidity, or let's say from one side, like buy side liquidity, to sell side liquidity. Okay, in every time frame. And this you need to exercise how to see in which time, like in the next 30 minutes or in the next 1 hour, time has a price has a high probability to go to a draw on liquidity. So after this liquidity got raided, the stop hunt, you have a high probability because that the price will go down, because you had this as a market structure shift and this as your price delivery array reaction as a manipulation with continuation. Okay, so that was the midnight range setup. You don't always have this every day. It depends always on the market structure. And of course, you have a higher probability if you have more things which are aligning, like higher time frame bias, intermediate time frame inefficiencies, for example, and the most important, the ICT macro time. Okay, and what's also important to know is, like, really important, you should note that price never delivers before ICT macro time. It delivers during it or after it. So if you see price right here at the end of ICT macro time, like 10 minutes after London open, you can see that price delivered during the ICT macro time, because right here is liquidity. Okay, right here is liquidity. That means what stayed open again? This single low stayed open. Because why the market should go up from here? Which reason you have for it? You have no reason for it, because you had the structure before which told you literally, look at me, I will go down. It's just a retracement. And this is just a stop hunt. If you are in too early, I will get you. And after this, the real move starts. If the real move doesn't expand further, you don't know that. You don't have to know that. Doesn't matter. It's just about the high probability at the right time. Okay? So if it doesn't go further down, doesn't matter. You have the high probability entry at the right time after the structure confirmed it, not before. Here you don't have a confirmation. Here you also don't have confirmation. Okay? You have confirmation after the manipulation with following market structure shift, and then you need time and price. Liquidity plus time. That's high probability. And it also doesn't need to go exactly to the midnight range low. Okay, it doesn't have to. You have to watch the other time frames. For example, if you watch it, you have to see what's aligning. 3-minute time frame. What can you see here? Nothing. We search an order block or something. If you watch in the 5-minute chart, what we see here? We can see like this bearish candle. It's the mitigation block. Okay, so it's just a definition of an order block which is inside a movement. So it was just an order block in lower time frame which followed a bullish movement. Okay, so the last bearish candle before a bullish movement. But that's not enough. So we watch the 15-minute time frame. We watch the 15-minute time frame. And it was, where was it? 8, right here. In the 15-minute time frame, what we have? We have a 15-minute order block. The big blue candle you can see here, right here. That's the order block before market went down. Okay, so we had we had this bearish candle after it, the big bearish candle, and that confirmed also in the 15-minute chart that price has a high probability to go lower or to go again to a discount price area right here. Okay, so it pulled back, it did a retracement with this 15-minute candle, and in the lower time frame you found your entry right here. Okay, same thing, you can divide this order block into levels, into 4 levels. The midpoint, the consequent encroachment, is the most strongest one. But if we see this like a reaction on the lower quadrant, it means the order flow is strong bearish. That's even sometimes better than the midpoint. So if we watch again in the 1-minute chart, you can see this level right here. So the first potential entry after it got liquidity, and you see this is also called TS, turtle soup. Turtle body soup just means a fake out. Okay, you have a fake out like here, and then how to define this is you need a fair value gap. Okay, you need a fair value gap. You can either take this in the 1-minute chart, or you watch how it aligns in the other time frames. For example, the 3-minute chart. Okay, so if you watch the 3-minute chart, you have it's difficult to explain. You can see everywhere fair value gaps. Okay, so right here you can see it here. You can see it also here as an inverse fair value gap. How to know which one is the right one? That's the biggest or the most common failure as a beginner. That's normal. So what you do is focus on time, not on price. Price is secondary. Time is first. Okay? So you watch where price is at the right time. ICT macro time, London Open, goes from 50, so from here, from this candle to this candle. Okay? And we know it never delivers before ICT macro time. It delivers during it or after it. We saw the structure. We saw London Open. London Open was right here. And then we waited for the structure, confirming it. First, market structure shift. Second, liquidity. Third, turtle body soup. Fake out. So we can see the price going out somewhere over a high and coming back fast, creating a fair value gap. If you have, like here, this fair value gap, and on top of that directly another fair value gap, what you do? You combine it. It's one inefficiency where you have the possibility that price will balance it or reference to it before the moves continues. Okay, so you not only have the confirmation of the market structure shift right here, you also have the confirmation that this was a fake out because it created an intentional move on the downside, creating a fair value gap, an imbalance, an inefficiency which price will test. Okay, it offers it offers fair value for price to continue lower to the downside. So we have one blue candle, and then we have a so-called immediate rejection right here. So if you have an immediate rejection like here, like just short in this imbalance, that it doesn't have to go to the consequent encroachment. It reacted here also at the lower level, at the lower quarter. That means first, bearish order flow is strong. Secondary, it means there's no inefficiency which needs to be balanced anymore, because you saw the reaction. It was going up and directly going down. So the latest entry, if you don't entry in this inefficiency, because maybe you are a beginner and you don't have this experience, which is normal, you don't have always the perfect entry, then you get in with the closing price right here, okay, to go short with high probability short. So if you go in right here, your stop is not above this. That's also a failure. Of course, your chance risk is better, but you still have a mid probability that you get stopped out here, because it can do multiple stop hunts right here. Maybe one time it reacts again fast, second time it reacts again fast, and always you get stopped out because your stop loss is set too greedy. So watch the structure. At least you put it over this inefficiency, and even then you could get stopped out. Target is the low, okay? Even then you could get stopped out. And not every structure is also good for potential, okay? Because if you would put your stop loss conservatively over this high, which would be the most conservative stop loss you can do here, so you have a very low probability that you get stopped out, you pay with your worst chance risk, but it's still okay. So your matching win rate gets better, but your win gets worse, because you have to put your lot size lower, so you don't risk too much in this area. The goal is not to risk 5% or even 1% in this area. No, the goal is that you have a consistent performance with a good win rate, of course, and of course also less losses, okay? So if you have, with some setup you choose for yourself from ICT, a good win rate, and you have experience with the setup and the structure, then you can say, okay, I know the price has a very less or very low probability to come over this after it created this structure, because you will see this. It's not a pattern, it's a time-based movement. You can see repeatedly, okay? It repeats always from time to time, different setups. And then you have your favorable setup for you, and you have a better chance risk. And then you have here your conservative entry for this short-term short, okay? What you also can do, if you see this swing lower right here, you can see this order block. The last candle right here, which is bearish, is the order block before this bullish movement. So if you are not greedy in the beginning and collecting experience, you can set your take profit conservative to the consequent encroachment of this order block. So you have definitely your win, and you don't have to fear that it doesn't reach this low, because sometimes it happens that it doesn't reach this low. It just creates another equal low which stays open, and then market goes up again. if something stayed open on the upside, on the buy side. So if you want to have, or if you want to get trust in your strategy, in the setups, in the beginning, don't put your take profit too far away. Okay, take the low-hanging fruits. For example, this low with this wick. It's obvious. Watch the obvious levels in your chart. Don't take the lowest one. Don't try to predict the highest or the lowest point. It doesn't work like that. I don't try to predict this high or this low or this low. I wait for confirmation. Always confirmation, confirmation, confirmation. Liquidity in time, confirmation, inefficiency, entry. Or here entry, okay? It's always the same thing. I never, or rarely I go in on the top or the low of a move in the market, because mostly you don't have such a high probability, because you never know how often the market will do a stop hunt. It can happen 10 times. Okay? Wait for the confirmation. That's it. Okay, so far to this midnight range. We had the London session, so the London kill zone built a range. Yeah. Also, for learning it, just draw into it your equal highs and lows, so you get used to it, to see those levels. Okay, you can see those levels everywhere mostly. Sometimes it's more clear, sometimes it's not the best, but you always see like a zone which gets raided, and then you just need to align the other things, time and price. Okay, that's it. I know it's for beginners, it's difficult and complex, of course, but seriously, for the English community, you are so lucky. You are so lucky. You don't know how lucky you are, because ICT is English. I spent years on understanding his videos, okay? Because my mother language is German. I try to translate, and sometimes I didn't understand anything because it was unclear and something. You are so lucky to have him on English. So I think for the English community, this is a crazy advantage. Crazy advantage. Definitely. So, New York kill zone start. What I draw into is the first presented fair value gap right here. We had right here liquidity over this high from the London session, and then we got this displacement. Okay, it's a price displacement. It shows intent, and these two fair value gaps, what we have right here, is also one fair value gap, because it's directly after each other. Okay, so this second fair value gap right here comes directly after the first one. So it's one inefficiency and it's one zone. Okay, you observe this. You observe this because you had right here a strong reaction. You had the range. And after price got sell side liquidity right here below these equal lows, it went to the buy side. If you don't get an entry, like here in this first presented fair value gap of the pre-market, of the New York Kill Zone. That's why here is first pre. It means first presented fair value gap, the first presented inefficiency imbalance from the New York Kill Zone. It has to show you a displacement. Okay, it's not just about finding a fair value gap like this. It's from here 789 to 788. It's one, not even 1 point. That's too small. That's not a displacement. It's, yes, it worked right here. It came back and it reacted, yes, but it's low probability. So watch out for the obvious displacement. Zoom a little bit out. Then you see the range of the London session. And then you see the displacement. That's our intentional move, what we want to rely on potentially in the future. So, and not always you get an entry. Okay, sometimes price is coming through, doesn't came into it, even not to the high. Happens. Then you wait for the next chance. Or if you have experience, so you saw this sell side liquidity rate and you saw yeah, well, it's a bad market structure to explain this example, but in the 1 minute chart, this is our market structure shift. Okay, so this is buy side liquidity, and after this we expect a retracement to the sell side liquidity, to the other side of the liquidity. And normally in this case of scenario, I would prefer an entry right below here. Okay, because that's a, if you see like one big wick and after this another wick, this is where liquidity rests. Okay, but that doesn't mean that liquidity only rests right here. It's a zone. So of course liquidity also rests right here. Okay, and it also could have reacted already until here. You don't know, and you don't have to know where the reaction come. You just observe it, and if you don't get the perfect entry, you wait for a later one. And you had this right here with this busy buy side imbalance, sell side inefficiency. Okay, because it was a liquidity rate following an intentional move, reacted at the London Open. What stayed open right here? These equal highs. That's engineered liquidity. So when it came back to this inefficiency right here, you had the high probability that price will go up again. But those things you only see if you have experience with the setup. It's also not high probability, it's low probability, because you only have high probability if price would came back, for example, here in the first presented fair value gap of the New York Kill Zone to the consequent encroachment. That would be high probability. Okay, because you have a bigger move to the upside and also a more clear market structure shift, because the small structure what we had on the downside right here, or this single movement, it didn't make a new higher high above this. So it's very difficult for beginners to anticipate those things if they don't see those equal highs. Okay, especially if we are in a market environment like we have it right now, with daily changing information, and the market is very choppy. So it's a very hard market at the moment, since a few days or a few weeks, to learn it. Okay, but there will also come better times again after we leave the range in the daily chart. Okay, and so until then, it's better to just learn and trade with low risk, and then you get to learn to anticipate those things. To anticipate this, how I said, you need to see the liquidity rate, you need to see the intention, where is the most probability for price to draw on. And after you had this sell side liquidity rate, these equal highs from London stayed open. Okay. From the downside, you also have this what stayed open, or what was here created, yes, but it got rated right now. So it can go lower, but the probability is higher that after it got rated right now on this side, that it first goes on the other side to rate this one before it comes lower again, what we saw later then. So don't rush the thinking what has to happen. Just observe and say, okay, it got here liquidity, now it's the higher probabilities on the upside. And because we are below the first presented fair value gap, the entry right here is not high probability, because it could still come here, react, and go lower again. That's why I would, when I see this candle goes up here, I would directly put my stop on break even. Because otherwise, if you let your stop, for example, right here after you went in this inefficiency, price can create another turtle soup with the next candle or with the same candle. It can go down very fast. So you need to have the right management of your trade. Don't wait for price to go higher, or pray for it. If you are inside the trade, manage it. If you have a good entry right here, put your stop loss on break even and manage it. So if price goes down, you get stopped out, break even, no problem. You wait for the next chance. You have plenty of chance in the day. You don't have to have every trade which is possible on the day. Okay, so price went up, got the buy side liquidity right here, and then we have, after we got the buy side liquidity here, it went to the sell side liquidity again, which stayed open and were created right after the open of the New York kill zone. Okay, reacted again right here. We had a sharp reaction right here again. We got liquidity again right here, and we had a beautiful structure right here. We had a range. We observed this range, and the first side which gets rated, which was the buy side right here, is our first potential entry. Okay, because it gets liquidity right there. If it gets first liquidity right there, you watch on the other side what stayed open. Sell side liquidity stayed open, engineered liquidity. So you have a high probability chance that it goes from here to here. If it goes lower, like here or here, it's not like the probability goes lower the farther, how you say, the more you try to predict in in the future, okay? Because it's a longer time you try to anticipate. Try to anticipate short time. And you also can not just only watch this liquidity movement, okay? You have to watch what shows you the market structure before. That's important because in the overview, you had this liquidity right there. Yes, you can say it stayed open, but what's more obvious in this structure what we have right here is first these equal lows and this sharp reaction, okay? It's pretty uncommon that price leaves an imbalance like this wick what we had right here open, okay? It's an imbalance. It's an inefficient price. So even when we are in the 1 minute chart, you can divide this into the quarters, and the consequent encroachment you can take as a take profit level, for example. As a conservative low-hanging fruit take profit level. The second one would be at the low, for example, okay? So watch out for obvious wicks. And if you have a pullback like this here, which got liquidity right here, that's very, like with a sharp move down, it's the same thing, and it's a better example to explain this. What's a turtle soup? That's our turtle body soup, okay? That's our inefficiency, which was created after this fake out, which got liquidity over these highs, over the swing high. And also, if you watch out for aligning with the other time frames, where was it? Here. You have a 3-minute CB from this wick to this wick. That's our 3-minute CB. And that's a perfect example to say following words. The wicks do the damage and the bodies tell you the story. Note it. Note it. Because the bodies tell you the closing price stays below the consequent encroachment, okay? Right here is the consequent encroachment of this inefficiency, of this displacement. And why it's in displacement? Because it created a lower low to this last swing low before the manipulation happened. Okay, that was the manipulation right here in the New York Kilt Zone. And that was the displacement. So it shows you the market will go lower with high probability. You just have to find time and price and aligning conditions. So if you didn't got this entry right here with the closing price, for example, or if you are in the 1 minute chart, and if you didn't go into it, for example, here, after the liquidity rate right here, and this sharp movement downwards, you don't have a confirmation yet right here, so it's the difficulty to anticipate this then for this setup. If you didn't get this entry, no problem. Wait for your next chance right here. In the CB, which was created with the turtle body soup, which you have right here. Okay? That was the fake out. It came down, created this CB, this fair value gap. It offers you a fair value price. Price doesn't have to come to consequent encroachment if order flow is strong. order flow is strong bearish right here. And you also have to consider if you have other imbalances. For example, this. What do we have right here? This is called a volume imbalance and is many times used for a pullback and for re-entries, okay? If it aligns with other things, what we have in this area right here, like the fair value gap from the turtle body soup, liquidity over these equal highs, the let's say, I think maybe lower quadrant. Yeah, lower quadrant of the first presented fair value gap. ICT always says, maybe you saw it, on the tick, baby, on the tick, okay? That shows you the algorithmic delivery. It's, of course, it's not always like that for people who ask yourself this. Of course not. It doesn't mean that you plan to get in your trade right here. It just shows you for your analysis where you can see sharp reactions, which make your setup more high probability, because you have more things which are aligning. So here was your re-entry for your short. Okay? And the most important question, when was it? Watch the time, ICT macro time, okay? It's not like kind of any time. It's the ICT macro time. If you only watch price and structure, you will lose. I can tell you that. And if you draw into every fair value gap you see, you will lose. It's not that easy. It's not a three rule indicator strategy. Okay? It's a complex system, time-based. Price is time-based, and so you have time and price. Yeah, that's 3 p.m. German time. So equal lows stayed open, price went down, and I will show you also the trade we did in the live trading room. It was, let me see. So we had the first presented fair value gap right here. We rated the sell side liquidity right here and had a reaction at the upper quadrant level of the daily discount wick. That shows us we have a short-term bullish order flow. Not directly here at the reaction, no. We know it after this fair value gap, what we have right here in the 5-minute chart. After this displacement, this SIBI gets inverted. After that, we had the same thing. Liquidity rate move to the upside with intentional speed. Okay, not slowly. It shows intent. And we observe it in the 1-minute chart. So what we see there, we see from here, that's our market structure shift. It's the first sign for the market structure shift right here with the closing price in the 1 minute. But it's more safe to wait that you have a closing price outside this fair value gap. It's now an inverted fair value gap, an inverse fair value gap. Okay. And that also doesn't mean that you can get in directly at the consequent encroachment. No, you have to watch how price reacts and when it reacts. Okay, here was 3:35 p.m. so 5 minutes after New York open, and the first presented fair value gap from New York we didn't had yet. We didn't had it yet. So it's low probability to just go long right here. Wait, just wait. Be patient. Be patient for it to create. You had here the first presented fair value gap. And I drawed it wrong into it. It goes until here. Okay? Or nah. Do we have another one? Yeah. It goes until here. Why until here? Because you have here another fair value gap and you have here also another small fair value gap. So it concludes to one zone. Okay? One zone. And we still wait at this moment. Okay? We wait for it, what price does. We can see a range. We can see right here a liquidity rate at London high, so key liquidity. Higher time frame PD rate because it's a session high. It got rated, came back again, retraced to London high, reacted again, created a balanced price range in the 1 minute chart. We didn't got an entry right here. Unlucky, happens. 2 weeks ago we had it. Doesn't matter, we wait for the next chance. And that's what we did in the live trading room today. Let me see where I did it. Yeah, right here. So, what was the time? 5:10, so it's MetaTrader, so it's 4:10. 4:10 was here. Here I got in. It was not the best entry because it was inside this range. For high probability, always wait for the extreme, okay? Especially for beginners. But this area is, or let's say, the whole area of the first presented fair value gap is your entry zone, okay? Because, or let's say the most important level is the consequent encroachment. Look, when I activate the middle line, that's the consequent encroachment. So we had the same thing. We had this little swing high. We had here multiple reactions. ICT calls this price is jagged. Jagged. I don't know how to spell it, but if you see multiple candles with a with wicks like here, you can anticipate aligning with your analysis, higher time frame, structure, etc. That price is done right here. So for the short, I went in here and I had my stop loss above here. It still could have happened that I get stopped out because it's only the consequent encroachment and it still can do multiple stop hunts above right here, okay? If you get stopped out, no problem. Wait for the next chance. That's why you don't risk 1% per trade. I risked 0.2%. And it's not about making 2% win per trade. It's about being consistent winning with small wins over a longer time than a few weeks or a few months. Because you don't want to, how I said before, you can do a lot of money with short time risk trading, with prop firms, with everything. But you will come to some point where this won't work anymore because market conditions change. You change. Your personality change over years. So get rules, get a strategy, get a performance which you can stick to over years. So you can stick to it without emotions. Doesn't matter what the market does. Doesn't matter how the market changes or anything else. It needs to be, how you say in English, stone proofed. Okay, so this trade we did, and my take profit, I had low hanging fruit right here. First take profit also could have been here. That would be chance risk 1-to-1. I took it here, and you see that price went far lower. So I only took a small piece of this movement. Am I being sad because of that? No. Because of course you had the drawn liquidity here. Yes, I said it also in the live trading room, but you had still a low probability chance because the higher time frame didn't give you a clear direction. So I just traded from one side of the liquidity to the other side, where stops are resting, where liquidity rests. That's it. There will be multiple other days which have way better market environment, market structure, more clear, higher time frame bias. I don't need to risk now if I only opened one positions, everything, if I don't know if it comes here, or whatever, to think I have to do so much percent, and I don't have to. I took with this trade just, I think, 0.17%. That's okay for me for a trade in low probability conditions. I waited, and after live trading group, I got two other trades, also with 0.2%. Observed, waited, executed. Done and dusted. That's what you want for long term. You don't want to be a stressed trader trying to get every fucking move in the marketplace. Okay, I mean there are some traders on the world who can do this, but I promise you, it's not about if they can do it. It's about if you can do it. If you can copy it, why you even care about it? You waste your time. I did that for years. Don't be such an idiot like me. Don't let yourself confuse with other performances. Focus on what you can actually do. That's all you need. Don't watch on Instagram, dude, how he did 10%. Don't watch other traders, why he sets every 20 minutes another trade. Why I can't do this? I want to also do this. Let this false imagination go. It costs yourself years of your lifetime. Okay? Focus on one thing to start and scale the shit out of it. Scale the shit of one setup, of one thing you really understand, you really deeply understand. Don't believe me, believe ICT. I literally teach you this, like I try to teach you the same stuff I learned from him or from other ICT traders. I mean, of course, he can explain it to you for sure better than me. He do that for 34 years. I won't say I can explain it better to you than him, but you will see he has some pretty long videos and sometimes it's pretty hard to understand, but you have an advantage. You can speak English, so use it. And yeah, be thankful for it, because there are so many people on the world which don't speak English, and I hope I can help them. I hope below you is some better trader than me. Maybe I can learn from you in future. Maybe you will realize in 3 years some things from ICT which I forgot after years or whatever. I hope we can build together a strong community where people in a few years trade together, so we stick out in this trading area on the world, because there's so much bullshit outside, and I wasted so much time, like everyone else in the world, or many people maybe also from you, wasted their time, their money for coachings which never helped you getting along anywhere. So stick to one thing, master it, and after this you can go further. Okay, so far today, nice that you watched. If you have questions, you can write me or in the German Telegram group. I will have in the next days the invitation for the new Telegram group. It's a mixed group for English and German community. There will be a English community question or discussion group, and also a German discussion group, but everything in one Telegram group together. I will keep you updated, and there will be also much more content than I delivered until now. So far today, I wish you a nice evening, and we will see us on Thursday for live trading room with indices, crypto, and Forex. See you then. Bye-bye.
Thank you for watching this video. Please subscribe our channel to get latest crypto trading prediction guide and tips, and write your opinion in comment box. If you like this video, you can like it and share it with your friends and others.